Okay, so many of you asking me to show live trades instead of past charts. So today we're here to show you how to trade and three-touch reversal and trendline break. So here in the Bank Nifty, the price closed at the demand zone. And here the price got rejected but failed to suppress the trendline selling, thus resulted in falling. And here, this is the third touch. Here the price closed, and we have gotten a huge volume spike confirming the trend reversal. But we wait, because there is a trend line that can reverse it back again. But price broke the trend line, so we are taking the entry here with stop loss at the break candle low and target as this key level. And we will wait, and let me tell you why this will work. Detailed rationale for the Bank Nifty trade setup. The trade setup is based on a confluence of three key technical indicators that suggest a high probability bullish reversal along trade. Demand zone support hold. The price has found strong support at a critical historical price area. Three-touch reversal testing. The descending trend line has been exhausted after its third contact. Trend line break and confirmation. The definitive break above the descending trend line confirms the shift from bearish to bullish momentum. 1. The critical demand zone hold support. The large orange box you've highlighted is the demand zone, a strong area of support. Initial logic: this zone represents a price level where buyers previously overwhelmed sellers, causing the price to reverse sharply upward. When the price revisits this zone, it is anticipated that the same large orders demand will be activated, leading to another bounce. Observation: the price fell significantly and closed at or just above this zone, indicating that the selling pressure was absorbed. The long green candles that form the initial base of the reversal confirm that buyers stepped in aggressively to defend this level. This forms the foundational support for the entire trade. 2. The three-touch reversal trend line exhaustion. The descending green trend line has failed on 3 distinct attempts, a classic pattern indicating selling exhaustion. Touch 1 and 2. The initial touches validated the trend line as strong resistance. Each time the price tried to move up, sellers entered the market, respecting the trend line and pushing the price lower. Touch 3. The setup. This is the most crucial touch. After finding support in the demand zone, the price returned to the trend line for the third time. The rejection and volume. The price was initially rejected at the trend line, leading to a small pullback as described in your commentary. However, this third rejection failed to produce a significant sell-off back towards the demand zone. Crucially, the subsequent massive volume spike seen in the volume bars confirms that a huge amount of trading activity occurred right at this critical juncture, indicating a struggle where the buyers ultimately gained control. Interpretation: the third successful test of a trend line, meaning the price holds support or fails to break resistance decisively, often signals that the strength of the trend is exhausted. 3. The trend line break and entry confirmation. The successful break above the descending trend line is the trigger that confirms the reversal and justifies the entry. The breakout candle, a strong, high-volume bullish candle, decisively closes above the green descending trend line. This move breaks the pattern of lower highs that defined the previous downtrend. This is a classic shift in market structure. Entry point. The entry is taken immediately after the breakout candle closes, or on the retest of the broken trend line, which now acts as support. Stop loss SL placement. Rationale: the stop loss is placed at the low of the breakout candle, the red line, in the red box, or just below it. This is a logical placement, because if the price falls back down and moves below the low of the candle that caused the breakout, it invalidates the entire bullish setup, suggesting the breakout was a false signal, a fake out. Target TP placement. Rationale: the target is set at a key level, the previous swing high, or a significant resistance zone, the upper green line in the green box. This level is chosen because it represents the next major obstacle where sellers are expected to re-emerge. This provides a clear, measurable profit target and ensures a favorable risk-reward ratio R, which is essential for successful trading. Why this will work. High probability trade. This trade is considered high probability because it has confluence, meaning multiple technical signals are aligning. Demand zone, support held, long-term buyers are in control at this price level. Trend line broken on third attempt. The short-term bearish pressure is exhausted and reversed. Breakout candle strong, close above TL. The momentum has definitively shifted from sellers to buyers. Volume spike confirms breakout. The move is backed by institutional buying, lending credibility to the reversal. The result is a classic bullish reversal pattern. The price has hit major support, the selling momentum has died out, and the market structure has shifted up. And finally, the price hit our target. So, just like trade with confirmations. And remember, it's almost not possible to show every setup on live example. Not always every price concept will appear on chart. There will be few rules and regulations for those to appear. Some might even change mid-time. That's why most of us show past charts, because it's simple to understand and explain and can be taught by it. If you're really that eager to learn or to disapprove, you can just cast those concepts by yourself. That's all for this video. Not much of a content, but still. Thank you all for watching.